Well, I'm joined now by Barclays Commodities analyst Amrita Sen to really take us through some of the movements that we've seen in these markets. And I guess we're seeing commodities right now trimming declines, aren't we? As really the US jobs report seems to have revived concerns that we won't see quite enough demand for oil or indeed raw materials.
Yeah, but I do think that we need a sustained data release of good data. One data point's not going to change that. We will need to see reassurances also from the policymakers, because at this point the signal that the market's been receiving, both from the data and from the government, is that, yeah, maybe things are not that under control.
Okay, so what about the price of oil specifically? Down 13% this week, poised for its biggest weekly decline since May, Amrita. I mean, this is pretty remarkable, isn't it? A month ago, we were speaking about sky-high oil prices, threatening consumers, feeding through to inflation. Is this starting to turn around?
Well, I wouldn't say so just yet, because we've seen this 4 times this year. We saw it during the Japanese earthquake, we saw it during May, during the big sell-off, then the IEA release of stock reserves, and now. So, I mean, we are now used to these very large movements in oil. But having said that, the difference this time round vis-a-vis the other times is we have had a spate of really poor macroeconomic data. And I do believe that unless that reverses, we get a good run of macro data, GDP numbers, PMI numbers, the pressure on prices will be downwards. It will continue to be choppy and move a bit lower unless that turns around, because the fundamentals don't seem to have deteriorated that much. Yes, US oil demand's a bit worse, but nothing else. And the supply side is still bad. Libya is still out of the market. The support should be a lot higher. You're looking at $90, $100 support level vis-a-vis, say, in 2008 when prices had gone down to $30. So I think that's very different. But yeah, I think in terms of daily momentum, the pressure is still going to be on the downside.
Well, then, so if we continue getting this stream of negative data, how low could we go?
Yeah, very good question. Like I said, I think this time round, given the fact that Libya is actually out of the market still, not expecting it to come back anytime soon, and because of the MENA unrest, most producers have spent so much money that they're looking for at least $90 to balance their budget. That's the $70 that we had last year. So it's at least $20 to $25 higher this year around. So it would be difficult to sustain prices below 90 for a long period of time. And I'm talking about Brent, of course, over here.
All right, so we seem to have focused a little bit there on the developed markets. Then tell me a little bit about demand coming from emerging markets, because yes, you know, we have had this spate of weak data, and some of the manufacturing data are also coming from emerging markets. But do you expect demand for oil and other commodities to remain as robust for the likes of China the rest of this year and then also for next year?
I think that's going to be the key. Chinese demand was a bit softer in June. And in general, emerging market demand was a bit softer in June, but we don't think that's going to last. Even if July is a bit softer, we would expect to pick up for the rest of the year and into next year. And the proportion of commodity demand and, of course, oil demand that comes from emerging market is so much larger now compared to the US that as long as growth in these parts of the world stays strong, commodity demand and therefore oil demand and hence oil prices will remain well supported. We don't expect a material deterioration from these countries, no.
Amrita Sen of Barclays, thanks very much.